Today, almost every country in the world has a central bank. Often described as the brain of the economy, central banks play a critical role in maintaining stability and ensuring the smooth functioning of a nation's currency. The only exceptions are two small Pacific nations, Tuvalu, with a population of about 9,500 people, and Kiribati, with around 132,000 people. While both technically have their own currencies, in practice they rely heavily on the Australian dollar, AUD, for most significant transactions, which shows that even they depend on a larger and more stable monetary system. The near universal existence of central banks comes from the fact that they work effectively. In today's deeply interconnected global economy, with dozens of floating fiat currencies, central banks act as a vital check and balance against reckless fiscal or monetary policies. They serve as an emergency backstop in times of crisis, manage inflation and employment, and provide a layer of independence from short-term political pressures. Beyond these high-profile responsibilities, central banks also handle essential behind-the-scenes tasks: issuing currency, maintaining liquidity, supervising commercial banks, and intervening during financial turmoil. In short, without a central bank, it would be nearly impossible for any modern economy to remain stable over the long term. In recent years, one of the more controversial ideas that has surfaced in U.S. politics and media is the possibility of abolishing the Federal Reserve. While this scenario is extremely unlikely, the very fact that it is being discussed has attracted attention from a wide spectrum of people, from serious economists and global bankers to conspiracy theorists who believe the Fed is part of a secret power structure. The argument for dismantling the Fed often points to its enormous influence. As the most powerful financial institution in the world, its decisions ripple far beyond U.S. borders, shaping interest rates, capital flows, and investment climates across the globe. Critics argue that no unelected body should have such authority over the daily lives of millions, and they question whether the Fed's policies truly benefit ordinary people. However, the practical reality makes abolishing the Fed nearly impossible. It is deeply woven into the global financial system, acting as both a lender of last resort and a regulator of currency. Removing it would destabilize not only the U.S. economy, but also global markets that rely on the dollar as the world's reserve currency. Still, it's worth noting that the U.S. has abolished central banks in the past, in the early 19th century, when concerns about concentrated power led to the closure of its predecessors. Today, the debate reflects a broader skepticism. As central banks take on greater responsibility in increasingly complex economies, people wonder whether their growing power remains aligned with the public's best interests. The idea of central bank did not begin in the United States. It has roots in Europe. Sweden established one of the earliest central banks in 1968, followed by the Bank of England in 1994. These institutions were created to stabilize national finances, regulate the supply of money, and support governments in times of war or crisis. In America, the story was far more turbulent. The first attempt at a central bank came in 1791, led by Alexander Hamilton, the first Secretary of the Treasury. He believed that a national bank was essential for strengthening the young nation's credit, managing government debt, and providing a uniform currency. Yet this first Bank of the United States was controversial. Many saw it as giving too much power to a single institution. When its charter expired in 1811, Congress chose not to renew it. A second attempt came in 1816 with the creation of the Second Bank of the United States. Once again, the institution faced fierce opposition, especially from President Andrew Jackson, who viewed it as corrupt and a threat to democracy. By 1836, Jackson succeeded in dismantling the bank, leaving the U.S. without a central banking system. The absence of a central bank had serious consequences. Hundreds of private banks issued their own paper money, making commerce confusing and risky. Banknotes varied in value, were often counterfeited, and created instability in everyday transactions. The turning point came during the Panic of 1907, when the banking system nearly collapsed. Only the intervention of financier J.P. Morgan, who organized emergency funding, prevented complete disaster. This crisis convinced both politicians and the public that America needed a more reliable financial backbone. Finally, in 1913, Congress established the Federal Reserve System, creating the foundation for modern U.S. central banking. When the Federal Reserve was first created in 1913, its primary mission was relatively narrow: to prevent banking panics and restore public confidence in the financial system. At that time, the U.S. economy was frequently shaken by bank runs, moments when depositors, fearing collapse, rushed to withdraw their savings all at once. Such runs could quickly spread from one bank to another, triggering widespread financial chaos. The Federal Reserve was designed to act as a lender of last resort, ensuring banks had access to emergency liquidity so the public could trust that their money would remain safe. Over time, however, the role of the Fed expanded significantly. A pivotal moment came in 1977 when Congress formally redefined the Fed's responsibilities by introducing what is now known as the dual mandate. Under this mandate, the Federal Reserve is tasked with pursuing two equally important objectives: price stability and maximum employment. Price stability means keeping inflation under control. Inflation erodes the value of money, making everyday goods and services more expensive. If inflation rises too high, it can destroy consumer confidence and destabilize the economy. On the other hand, deflation, when prices consistently fall, can also harm growth, as businesses and consumers delay spending. The Fed's job is to find the right balance, often by adjusting interest rates and controlling the money supply. Maximum employment reflects the Fed's responsibility to support a healthy labor market. While the Fed cannot directly create jobs, it can shape the economic environment to encourage job growth. For example, by lowering interest rates, borrowing becomes cheaper, businesses expand, and hiring increases. Conversely, if the economy overheats, the Fed may raise rates to slow things down, preventing runaway inflation. These dual goals are not always easy to balance. Policies that reduce inflation may sometimes slow job growth, while policies that boost employment may risk higher inflation. Navigating this tension is at the heart of modern central banking. Ultimately, the Fed's mission has evolved from simply preventing bank failures to actively shaping the economic landscape of the United States. Its decisions now influence not only Wall Street, but also the daily lives of ordinary Americans, affecting everything from mortgage rates to the prices paid at the grocery store. To fulfill its mission of ensuring economic stability, the Federal Reserve relies on a set of powerful tools. These tools allow the Fed to influence the flow of money, borrowing costs, and overall economic activity in the United States. The most well-known instrument is the interest rate. By adjusting the federal funds rate, the rate at which banks lend money to one another overnight, the Fed can influence nearly every corner of the economy. When the Fed raises interest rates, borrowing becomes more expensive. This discourages consumers from taking on new loans, such as mortgages or car loans, and motivates households to save rather than spend. Businesses, too, may delay investments because the cost of borrowing rises. Collectively, this cools down demand and helps bring down inflation. Conversely, when the Fed lowers interest rates, borrowing becomes cheaper. Families are more likely to buy homes or cars, and businesses are encouraged to expand operations. This injection of economic activity boosts growth and supports job creation. Another critical tool is open market operations, OMO. This involves the Fed buying or selling government securities, such as treasury bonds. When the Fed buys bonds, it injects money into the banking system, increasing liquidity and encouraging lending. When it sells bonds, it withdraws money from circulation, tightening financial conditions to slow inflation. In extraordinary situations, the Fed has used more aggressive measures like quantitative easing. QE involves the large-scale purchase of long-term government bonds or other securities. By doing this, the Fed effectively creates money and pumps it into the financial system, ensuring that banks have ample liquidity. While QE can stimulate growth during crises, critics warn that excessive money creation risks long-term inflation and asset bubbles. Through these tools, interest rates, open market operations, and quantitative easing, the Fed wields enormous influence over the health of the U.S. economy. Its challenge lies in applying them with precision. Tightening too much can trigger recession, while loosening too much can spark inflation. Unlike a traditional business, the Federal Reserve is not designed to maximize profits, yet its operations naturally generate revenue. Because the Fed has the unique authority to create money, it can purchase U.S. government bonds and other securities. These assets typically generate interest income. After covering its own operating costs and paying a small dividend to member banks that hold shares in the regional Federal Reserve banks, the Fed transfers the majority of its net earnings back to the U.S. Treasury. In most years, this amounts to tens of billions of dollars, which helps reduce the federal deficit. However, the situation has recently changed. During periods of quantitative easing, QE, especially after the 2008 financial crisis and during the COVID-19 pandemic, the Fed bought massive amounts of bonds at historically low interest rates. Today, with interest rates rising sharply, the Fed must pay much higher interest on reserves that banks deposit at the Fed. This mismatch, low returns from old bonds but high payments to banks, has pushed the Fed into an operational loss. Importantly, this loss does not threaten the Fed's survival. Unlike a private company, the Fed cannot go bankrupt because it has the authority to issue currency. Losses simply mean that for the time being, it does not remit surplus profits to the Treasury. In essence, while the Fed may show red ink on its balance sheet, it still remains fully capable of carrying out its mandate. The Federal Reserve and other central banks around the world face a set of increasingly complex challenges in today's global economy. Among the most pressing are the intertwined issues of debt, inequality, and political conflict. First, the challenge of debt and inequality is profound. In the United States, debt levels among households, corporations, and the federal government have reached historic highs. When debt is so large, small changes in interest rates may no longer be enough to stabilize the economy. A single percentage point interest rate in rates can sharply raise borrowing costs for millions of families, heavily indebted firms, and the government itself. This creates a dilemma. Tightening policy to fight inflation risks pushing borrowers into financial distress. Moreover, monetary policy often has uneven consequences. During periods of quantitative easing, QE, when the Fed injects liquidity into markets, asset prices such as stocks and real estate tend to surge. This benefits wealthy individuals who already own significant financial assets. Meanwhile, lower and middle-income households, who rely mostly on wages and hold fewer investments, see little direct gain. When interest rates rise, it is often these same groups that bear the heaviest burden. As borrowing becomes more expensive, jobs may be lost and everyday costs increase. In effect, the Fed is not just managing one economy, but rather balancing the needs of three distinct groups: the wealthy elite, the middle class, and the government, each with competing interests. The second major challenge lies in conflicts with government policy. For a central bank to function effectively, independence is critical. Policymakers must sometimes make unpopular decisions, such as raising rates, to control inflation even if it slows growth in the short term. Politicians, however, often have different incentives. They are motivated by election cycles and prefer short-term stimulus through fiscal expansion, such as increasing government spending or cutting taxes. This can directly clash with the Fed's tightening policies. A clear example is seen in the current U.S. situation. While the Fed is raising interest rates to cool inflation, the federal government continues to pursue expansionary fiscal policies, including significant public spending programs. This contradiction places the Fed in a difficult position, tightening monetary conditions on one side while fiscal policy pushes in the opposite direction. The result is a policy tug-of-war that complicates efforts to stabilize prices without triggering a deeper recession. In summary, the Fed's challenges are not purely economic, they are also deeply social and political. Managing debt, inequality, and conflicting policy goals requires not just technical expertise, but also the ability to navigate power struggles and social pressures. This makes the role of a central bank more delicate and complex than ever before. From time to time, people raise the provocative question, what would happen if the Federal Reserve no longer existed? In theory, the U.S. Treasury could assume many of the Fed's functions, such as issuing money and managing public debt. On paper, this may sound like a straightforward substitution. Why maintain a separate central bank when the government already controls fiscal policy? However, in practice, removing the Fed would pose serious risks. The most important reason lies in the issue of discipline and independence. A central bank is designed to make decisions based on long-term economic stability, not short-term political gain. If the Treasury directly controlled money creation and interest rates, political leaders might be tempted to use these tools to win elections, keeping interest rates artificially low or printing excessive money to finance government spending. While such measures could bring short-term growth, history has shown that they often lead to runaway inflation or financial crises. The case of Turkey is a striking modern example. The government pressured its central bank to maintain very low interest rates despite rising inflation. As a result, the Turkish lira collapsed in value, and the country experienced hyperinflation that eroded purchasing power and destabilized the economy. This illustrates the danger of a monetary system without independence. When discipline is lost, chaos can quickly follow. History repeatedly confirms this lesson. Countries where central banks lack autonomy often suffer greater financial instability, currency crises, and inflationary spirals. By contrast, when monetary policy is shielded from direct political pressure, economies are more likely to maintain trust in their currency and financial system. In short, abolishing the Fed is not simply a matter of transferring responsibilities. It would mean removing the very safeguards that prevent political short-termism from undermining economic stability. While the Fed is far from perfect, its independence remains a cornerstone of the U.S. financial system. The Federal Reserve is often referred to as the central bank of the United States, but in reality, it is not a single monolithic institution. Instead, it is a system composed of multiple layers designed to balance efficiency, independence, and accountability. At the heart of this structure are 12 regional Federal Reserve banks, each serving a specific district of the country. These banks operate with their own boards of directors and have shareholder banks within their regions. This decentralized design plays a crucial role. By distributing power across regional banks, the Fed ensures that no single group, whether from Washington, Wall Street, or any political party, can dominate monetary policy decisions. It also reflects the diverse nature of the U.S. economy, allowing local economic conditions and perspectives to be represented in the decision-making process. In addition, the Board of Governors in Washington, D.C. oversees the entire system, setting broad monetary policy and regulations. Meanwhile, the Federal Open Market Committee, FOMC, which combines members of the board and regional bank presidents, makes critical decisions on interest rates and open market operations. This unique blend of central coordination and regional input is what gives the Fed both strength and credibility. It balances the need for national consistency with the importance of regional voices, while also serving as a safeguard against excessive political interference. The Federal Reserve is unlikely to ever be abolished. It has become deeply embedded in the structure of the U.S. and global financial system, playing a vital role in stabilizing the economy during crises. However, its existence does not mean it is free from challenges. Internal issues such as mounting debt, widening inequality, and conflicts between monetary and fiscal policies remain significant obstacles. These challenges force the Fed to constantly balance between theory and reality, short-term pressures and long-term stability. Ultimately, while the Fed is indispensable, its effectiveness depends on how it adapts to these ongoing tensions and maintains the delicate trust of both markets and society.